Let's dive into all of this with our first guest for the hour. We've got Emily Weis, State Street macro strategist. And Emily, always good to talk to you for a good EM discussion here. Financial risks, when you think about the war that's played out between Russia and Ukraine, have largely remained in Europe so far. But I wonder how you look at how this is going to weigh on broader growth the longer this conflict goes on.
Yeah, so exactly as you mentioned, right now we've seen a pretty contained impact with a lot of the biggest fallout occurring in the regions that are either within Russia itself, which has had a pretty big hit and impact to both growth and markets, but also to Europe and the CE3, which have really been the most closely related to the potential sanctions and the impact therefore. Now, when we look at a broader impact, we are going to see this start to weigh on more global economic growth going forward. Right now, we aren't yet seeing that in GDP expectations, which has actually been pretty contained with just a slight revision lower. However, if we do start to see this impact in Europe through higher inflation prints, which we started to see overnight, and a bigger impact on recession risks, then that brings the rest of the world more into focus, particularly given expectations that the US could now be facing lower growth going forward as well.
Emily, let's kind of stay on the topic, though, of exactly what's been going on in Russia and Ukraine. We know both of those countries very important in commodities markets. Now, if we talk about specific exposure to Eastern Europe, has the picture gotten any better with some of the negotiations that Akiko and I were just talking about? Or do a lot of EM managers kind of say, let's kind of still stay on the sidelines while we continue to watch these developments?
Yeah, so for us, we're certainly staying more on the sidelines, taking a bit more cautious approach, just because it's really hard to trade geopolitical tensions, and particularly the peace talks and outcomes. While we really hope for the best, it's been sort of a one step forward, two steps back process this whole way. We are still hopeful that there will be a positive resolution, but in the meantime, it's hard to really start to make those longer term allocation decisions, given it's hard to understand when the sanctions on Russia itself might actually be taken off. From a market's perspective, we're sort of tasked with looking at how much is already in the price when it comes to these sanctions. And so certainly we've seen that the way the situation is right now, investors have adjusted to the new reality, but that still is contingent on how long this eventually plays out, which is the major unknown.
For the mom and pop investor, or maybe we're calling it Robinhood investor these days, that maybe just wanted to have emerging markets exposure, I guess there's a question, though, about what is the true Russia exposure. We know that, them being one of the BRICS country means that they're pretty substantial. But if you're invested in, let's say, your iShares emerging market fund, how much exposure do investors have to Russia right now? I don't mean to get into the nitty gritty of ETF composition, but we know that a lot of Russian equities have been frozen, for example. So have these kind of funds been able to prune that exposure, or is there still a little bit of risk there?
Yeah, so funds have been trying to drop Russia from some of the key benchmarks, although that actually might end up benefiting other emerging markets that might take the place of Russia in those benchmarks, such as Mexico and Brazil have been brought up. So there really is this shift and this allocation going on underway. And certainly the sanctions regime is something that's unprecedented. We haven't had to deal with this sort of extent of essentially financial warfare going on, where a government's assets have been frozen through a central bank, and also seeing the stock market in Russia actually having to be closed for an extended period of time. So while a lot of those nitty-gritty details in terms of exposures are being ironed out, we've actually seen this rotation from investors going from looking at emerging markets as an overall complex to looking more at regional differentiations. So actually Latin American equities, the MSCI LATAM index is one of the few regions that are positive on the year, actually up 20%. The similar thing is seen in the FX space. So there still are pockets of exposure, and I think we're going to see investors turning to more of the differentiated regional impacts rather than looking at the index as a whole.
Emily, perfect segue there for what I've been wondering, which is, how this conflict has shifted the way investors price in geopolitical risk. It sounds like you're saying it's moving regionally. The money isn't necessarily moving away from EMs overall, but to specific EMs. How do you think that thinking shifts, though, as a result of what's played out, not just on the military side, but especially on the economic side with the huge spikes that we have seen in commodity prices?
Yeah, commodity prices has been the key differentiator. And definitely when we look at the currencies and the equity markets that have done particularly well since this crisis happened in Ukraine, it is the countries that are commodity exporters. So there is a divergence emerging here between commodity importers and exporters in terms of who's going to be most impacted and might even, in some cases, benefit economically from this horrible humanitarian crisis. So looking at those nuances is definitely important. And when it comes to looking at pricing in geopolitical risk, I think these sorts of events are always a reminder that that risk really is there. There is always this preference to look at geopolitical events through rose-tinted glasses, and certainly this last month has been a wake-up call for a lot of investors who had become a bit more complacent on watching Russia and what was going on.
And then, Emily, lastly here, I kind of want to ask about FX markets specifically. And I know that this is a bit noisier because we know that interest rate differentials as we get hawkish central banks is likely a factor in this as well. But when you look at the Russian ruble, you have some people saying, actually maybe a little bit more surprised you haven't seen further devaluation despite some of these headlines here. What are you seeing in terms of movement specifically in the ruble?
Yeah, so I'm cautious to read too much into this sort of bounce back that we've seen in the ruble. It's obviously very difficult to trade rubles right now, and there's a lot of potential sanctions implications that come along with that. We've heard about how Russia is requesting that some of the gas be paid by Europe in rubles, and that's been a major point of contention because they might run afoul of sanctions. So it's hard to read too much into prices at the moment, given the restrictedness around both currencies and equity markets. But some of the relief is reflected, although we're still up on the ruble around 12% year to date, 12% weaker versus the dollar.
Yeah, no, certainly. So many headlines kind of flurrying around the Russian ruble, especially when you see the government demanding the settlement of, let's say, for example, natural gas in rubles. But there's just so much in the weeds stuff about how you would actually do that. Would that violate sanctions? So just so much legalese to parse through there. But Emily Weis, State Street Global Markets macro strategist, thanks again for stopping.